AI bubble talk is everywhere. Markets have slowed down at the end of 2025 and doubt is starting to creep in. So today we're looking back at what we did in 2025 and forward to how we're approaching 2026.
Hey Darren, it's great to see you again, and Happy New Year. Our
Yeah,
first
you
our
too, Paul.
first video of 2026. Um, how did you finish 2025? Did you hit your goals, or were you surprised
Yeah,
by anything?
I actually was. And I know that you and I have talked prior to recording this video and others. We tend to talk beforehand and we message each other, obviously. And I remember telling you, you'd asked me how much I contributed this year, because as everybody knows, I'm still in the accumulation phase where you're not in that situation, which makes this, I think, a fun comparison and conversation. And that one was a huge surprise to me. And I haven't done my year-end wrap-up video yet. I've been pretty busy, but I will be sharing how much that was. I did kind of hint at it in my last video, but yeah,
Mhm.
that was super surprising. So, and as far as goals overall, um, the big one for me is learning. And that's why I enjoy these conversations with you and other creators in the space. And obviously, I want to grow my knowledge every day. And I think if you're not, then you're not doing yourself any favors, especially as a DIY investor. If you're not going to take the time to learn, it's probably better to just simply go pay, like the managed portfolio, say from Simple. The costing on it is fairly low, and it's no headache. You can go to sleep at night and not worry about it. But for me, doing this, I want to learn every single day. You?
Yeah, no, I agree with you. I've been sitting down thinking, how can I best manage my time, right? Because if you wake up in the morning and you're not going to work, it's very easy to, take the dog for a walk and then plop yourself down on the couch, put on Netflix. Next thing you know, it's 4 or 5 p.m. And you haven't, like, I usually have my laptop with me. So I'm trying to, go over some comments people left on videos and update some spreadsheets. But really, by the end of the day, you're like, man, I should have went to the gym. I should have done this. I should have done that. So I'm starting to think about making a list of almost like I get up in the morning and I'm going to do these 10 things every day. And one of them was I get an email every day from this website, and I can't think of the name of it right now, but basically it's a 5 or 6 minute overview of the markets. Like they do it
Okay.
for you. You don't have to watch the news. You don't have to, dig into a lot of research. They just give you an update on what's going on. And for 5 or 6 minutes, why not? Just sit down and read that to start the day. And I picked up a new copy of David Chilton's The Wealthy Barber. He
Yeah.
rewrote it like 30 years later. It's updated, right? So I'm assuming there's going to be some cryptocurrency in there and some other modern stuff. So I'm gonna start reading. I need to read. It's one thing to watch YouTube videos and, all the talk we do with people on Blossom and together, but I think I need to start reading a bit more as well. I don't know
Yeah.
if you know, but Ari and Ryan's podcast, In the Deep End, they have a book club.
Oh, they
So
do.
yeah, they have a book club. So pretty soon they're gonna let me know what their next book is, and I think I'm gonna cheap out, maybe go to the library, see if I can get a free copy, and force myself to read that because it's part of the club, right?
Yeah, I mean, that may sound funny to some people, but so when I did my video on the Smith maneuver, I kind of did it a little bit backwards because I knew that other people were doing it, in particular Mo from Momentum Finance.
Hmm.
And I'll leave his link in the video description below if you do want to check out that video if you're interested in the Smith maneuver, which is a great way to leverage the equity in your home to invest. I actually ended up going to the library before I move forward. I put the video up, but I was like, I need to read this book too.
Yeah.
I got it from the library. It was free, and it didn't take me long to read it. The way I usually do it is audiobooks. So if I can find it on Spotify or some other platform, I will listen to it because, like you said, Paul, well, for me anyway, you have a bit more time on your hands than I do, but when I'm transiting to work or if I'm taking the dog out for a walk in the morning, I try to utilize that time to do those things that you're talking about, whether it be an audiobook or listening to a certain podcast. I'll even play, sometimes you can find on YouTube, you can find people have narrated some of these books themselves. And if you play it, on your phone, as long as your phone doesn't close, you can actually just hear the audio for it. So that's
Right.
another great way to listen to, you know, books and about investing and things like that. So yeah, that's a great suggestion. And just like you, I did do that. Obviously, because I do the channel as a part-time gig, although it does sometimes feel like a full-time
Full
gig for
time.
me. On top of my regular job, I
Yeah.
set out some things that I would like to do with the channel this year. And for those of you who have been watching both Paul and I do this series and my channel or his channel, it is a lot of work. I saw Paul did his year-end video where he talked about how much he made. And I think probably for a lot of people, it's probably a bit eye-opening because it's a lot of work on the back end that you don't see. And the reward in it on the financial end is it's
Yeah.
it's not really why we do it. You know, obviously, like for instance, with me, I have links. For one of them is to buy me a coffee. A lot of creators use it in order for you. You like the content, you can. It's like tipping is kind of the way I would put it. And I've
Yeah.
actually had a few people use it. And I'll be honest, like it's only been used 3 times by people, but it actually makes you feel really good because
Yeah.
they leave you comments. They genuinely say like, we really enjoyed your comment and here's how we feel about it. So that's pretty cool. So I have set out some things that I'd like to try and accomplish with both my investing and the channel, but I also built in that part that you're talking about is yes, I spent a lot of time working with my family and doing this, but I want to have a bit of a healthier mindset as well. And so I have a bit of a workout plan for the rest
Yeah.
of the
Right
year.
on. Yeah, and I what I did a couple days ago was I set up my laptop in my son's room here and on desk instead of sitting on the couch because even just sitting in an office chair, my back, like the one day I was down there for 6, 7 hours, I could hardly move afterwards. Like it's so bad for you. So trying to figure out ways that I can do things better, healthier. But it was funny, the video you were just talking about, I was reading through the comments and somebody made a comment like, I thought I was doing well. I thought, I was making a bit of money. And somebody pointed out that in November, all the videos that I made and the money I made from it was something like $30 or less than $30 per video. And when you think about the time that you put into making a video, my wife edits it, but we sit together and she asked me, why did I do this? Why'd you do that? You should have done this differently, So it's a stressful editing process, right? And then on top of that, after you put the video out, then you're following up with comments and I try to reply to people, right? And before you do a video, you have to set everything up. I try to get my spreadsheets accurate and put some content into it. Anyways, by the time you're all said and done, what are you making? $5 an hour? $8 an
Uh,
hour? I don't even
if
know what it is, but
if that like
right?
I think the big part too is like understanding what the audience. So you guys are all listening to Paul and I chat. This is going to be more of a real open conversation as far as like what we went through, and I think it's important. Like I saw your video and I had been thinking about doing one as well. I didn't want to come across, like boasting about things or perhaps complaining about it. But I think it's important to understand that there's a lot of work that goes into it, especially as a
There is.
beginner, because I often say that in my videos. Like, I definitely feel more confident the more I talk, the more I learn. But, sometimes you get comments and you're like, okay, that person was poking fun at me, or they were, they were testing whether or not I knew what I was talking about. So when I go to answer questions, just the questions alone that I get, sometimes I have to quickly go back and do some research to make sure that I'm saying the right things because
Right.
I don't want to send people down the wrong path. Like
Yeah.
the whole reason I share this is I made it to 50 and I had little to no knowledge whatsoever about DIY investing. Now, April will be 3 years since I started investing and I started this channel. And I see a path, I guess now. I see how this is helping other people. And that's kind of the key for me. And the gratitude that I get from people is kind of what makes it worth it in the end. Obviously, having some monetary reward for it is, a good thing because, like, for instance, I think I don't, like I bought a new laptop this year. The laptop that I was using, like it was not good and editing took a long time. And so I end up spending more than I made on this laptop.
Yeah.
And that's just the way, that's how you run a business, right?
Well,
It
hopefully
is a
not.
business. Well, but it is a business though. Like you
Yeah.
reinvest back into the business. So Yeah, those things I think are important for I think creators to share at some point in the year just to remind people if you enjoy the content. And I guess it's a good place to say it. We say it all the time as creators, the thumbs up, the likes, and the shares and the subscribes, that is actually more powerful than a lot of other things that we see in the space because the algorithm likes it. If you
Yeah,
guys all hit like, if there's 1,000 people that watch this video and they hit like, this video will get pushed out to more people. And
right.
we see it on the back end in our analytics when people, like I have a video right now that I'm not it's been posted, it's been around for a while, and it's for some reason people are latching onto it and it's growing quite quickly, which is interesting to see. Like, and it's
Wow.
one of my better performing videos, and it was just a regular video that I did. So that's kind of neat.
Yeah. Yeah. Well, I actually appreciate the fact that that guy pointed out, how much I was making per video, because now I really do understand that it really is a passion project, right? When people say that it's a passion project, you're like, yeah, yeah, whatever. You're making money on YouTube, right? It's not necessarily, but you know what? It really is. And for me, back in, say from 2020 till I started a channel, I watched a lot of other people's content, and that's what kept me motivated. But now making videos keeps me motivated, right? Trying to help other people, but also now now you have to make sure that the decisions you're making are actually better decisions because you're sharing this with people. You know what I mean? So it's forcing me to really evaluate my whole investing, thesis or what I've done for the last couple of years. And you and I always talk about. I remember the one day you told me about like the apple tree, right? We were talking about
Yeah.
apple trees, and
Yeah.
sometimes I like to think of sports teams, right?
Yeah.
So the way I look at it is for the last couple of years, I've been really focusing on offense, right? Putting everything into making money, but not focusing enough on defense, right? So
Yeah.
that's where my portfolio is taking a hit sometimes, where the share prices are dropping or the NAV's dropping, or, I own some high yield funds that aren't paying as well as they used to. So I think this year I'm focusing more on the defense, I guess, or as Perry calls it, the anchors, right? I got to work on my anchors and
Yeah.
build up my portfolio that way. But it's good. You end up being held accountable
You
from
do.
making videos and trying to share your journey with people, because now you really have to think twice about what you're doing.
Yeah, that's true. Actually, one of the creators that I watched, Canadian dividend investor, his name is Riley. He does that. They literally said that's why he started his channel, and he posts videos quite frequently. And he focuses on the fact that you're trying to keep yourself accountable. And I
Yeah.
can assure you guys, like if you think that you have a Type A personality, which I know to a certain extent I do, your personality can be absolutely shattered doing this because you're putting yourself out there
Yeah.
to your audience. The thing I try to remind myself is just like you said, Paul. I do take all those comments and I take them in and I go, okay. Like for instance, recently I'm getting you have a lot of overlap,
Right.
and I do have some overlap in my portfolio. That is there, absolutely it is. But there when I sat down and I kind of analyzed why that overlap is there, I equated it to because I'm holding CAD and USD. About
Right.
50, it's 50-50 split. And following the portfolio that I have, you're seeing the same funds in USD as in CAD. So it looks like I have double the amount of funds, but I don't. They're essentially the same thing. They're just held in USD. And the
Right.
purpose behind that is that I believe that the American dollar will remain stronger than the Canadian dollar. So when I eventually convert those funds back, it'll be worth more to me. That's the thesis, anyways. So, but comments like that one, they do test you. It's like, okay, they're saying I have overlap. I should probably dig into this and figure out what does that mean and how do I
Yeah.
meaningfully respond to that. I am no expert, so I have to come at it from that beginner lens. So that was sort of the explanation that I came up with for now, is that you're seeing the same funds just in different currencies.
Yeah. And I've always liked to sit down on my computer and just create spreadsheets and track certain funds or compare things. But what I like now about, starting fresh in 2026 versus last year, now I know that I have a YouTube channel. I can start off the year and track things a certain way so that at the end of the year, I have all the data. Or when you and I sit down and chat, I have more accurate information, right? So I love it. And my video should be coming out soon. My December month end, but I guess combined with year end video should be coming out shortly. And it forced me to sit down and make a list of goals. I think I ended up with 6 or 7 goals. And I was actually thinking I've got to go somewhere where I can get this printed in color and like
Oh,
laminated and literally put it on the wall in my office so that when I'm sitting down talking to you or working, I can see my goals and go, okay, now wait a minute. Am I actually working on these goals, or did I just tell people that I was for a video and now I've forgotten all about them? Because I don't want to do that, right? I really want to focus on those goals. And I think if I do, it's going to be a good year.
that's actually a really great point. So you guys can't see it behind me, but here, I'll just turn the computer a little bit. I'm in our bedroom. That door right behind me is our ensuite. Yeah, my wife's gonna kill me for doing that, but either way, um, in there we listen to, or my wife listens to, a podcast. It's a motivational one. It's not an investing one. It's a motivational one. And from it, there was these mindset goals, things that you read every single day to motivate yourself. And we
Nice.
thought that was pretty powerful. So we took it, printed it. It's up on the mirror in the bathroom, and it's downstairs in the kids' bathroom. So every day when they go in there, even if you only read one of them, there's about 9 of them on this list. You're motivating yourself, and I like that idea. I I don't have them written down, but I use ChatGPT. So I have a list, and I keep files in there of what I'm working on, and then I revisit them. So, like, for instance, I told you guys that I wanted to have some sort of workout this year to make my mind healthier and my body. And I use ChatGPT to help me figure out how to build that and how to track it. So I use that as a spreadsheet, like you, Paul. And I have spreadsheets that I've created for investing. They're a great tool to motivate you to look to see, because how many shares do I have now? What is overweighted? That's another big one, because every year
Yeah.
ideally, you should be revisiting your portfolio to figure out, what do I need to rebalance, right? Rebalancing could simply mean, well, I've been holding this fund all year and it's performed really well. The weighting in my portfolio is 20%, but it's grown so much, it's 30%. So I'm going to sell off 10% of it, and I'm going to reinvest that into a fund that's doing not as good. It could be, under your weighted asset allocation, and so you're going to take the money and put that in there. That's rebalancing. So that's an important thing, and you can use a goal setting spreadsheet to do that for you.
Yeah, definitely. And right now, I'm not rebalancing as you are, but I'm trying to reduce the number of holdings I have, because I think once I have a manageable number of holdings, then I can start looking at, okay, what percentage of my portfolio is in technology, how much is in healthcare, how much is in energy, how much is in financial, and then I can even you know, break it down more as to where I need to rebalance, or where am I too heavy invested in one area versus another. And I mean, in some cases, you might want to be more invested in things like technology, because really they rule the world, right? They're carrying the whole US economy. So to not be invested in them would probably be a mistake.
Yeah, that's actually a good point. So I'm in the intro that I read, we talked about there's a lot of discussion about the AI bubble. And if you look at history, because we can look forward and pretend we understand what funds will do, but we don't know. We
Yep.
can look back, and history will tell us what the funds performed like, but that doesn't predict the future. So it's kind of like gambling or a guessing game in some ways, but that history will lay things out. What we do know is that there is some stuff in the markets right now that is leaning towards that bubble, but we don't know if or when it will happen. And you make a good point, Paul, is the top 7 companies in the United States, the Apples, the Microsofts, and so on and so forth, they hold of funds that exist in the US market. They're market cap weighted. They hold a lot in those funds. So if there's a big change in those, you want to be diversified enough that if you take a hit in those funds, that it won't hurt your portfolio as much. Do you think about that stuff?
Oh, definitely. Especially, recently with what happened in November and December. Perry calls it the crypto chill, where Bitcoin, after it hit its peak of 126,000 or something, dropped all the way back down to, I think, in the low 80s. And, it took along with it, it took MSTR and I think Ethereum. And so Coinbase, I think that's another stock that was affected by it. So I realized very quickly that I had a lot of money invested in those areas. And therefore, my portfolio took a big hit. My monthly income took a big hit. So it made me realize that maybe I should be putting more money into some like other Canadian stocks, some other sectors, that are not tech related.
Right. Yeah, that's actually so I do use a percentage model of US, Canadian, and then international markets. And it could simply be because you're talking about the same stuff. What you're talking about is sector allocations. So when you talk
Yeah.
about healthcare and energy and things like that. So within the world, we have different parts of the world we can invest in, and there are funds that will allow us to do that. The S&P 500 is the one that most people understand, the top 500 companies in the United States, but there are other parts of the world we can invest in. Then within those funds, there are different sectors that we would want to make sure that our weighting, as you just pointed out, is not too heavy in certain areas. And you're right, the micro strategies and anything to do with cryptocurrencies definitely has taken a hit, and it's influencing the markets overall. I assume it's also politically motivated with other things going on. For instance, we know right now that the United States has gone to Venezuela. How do you say that? Venezuela.
Venezuela.
Thank you. So we know that there is some, action going on in that sector, and so what will that do to prices down the road? How is it going to affect those? If you had 50% of your portfolio in energy, you might have a little struggle right now because those probably taken a bit of a hit. They might recover too. You might do well. So I think it's important to be balanced. My spreadsheet that I have actually breaks that stuff down. So I know how many shares I have, but I also know within the portfolio what weighting, and you could add a category for that. There are tools out there as well that will allow you to see when you input what you're using, what sector you're invested in, what the pie chart looks like.
You still use passive. Is that your main tracking?
Yeah, so I use Passive and Wealthica. They kind of go hand in hand. So Passive's a great tool because what it does is if you have multiple accounts like we do, you're able to bring them together, and then it will show you percentages. It will break it down by each fund. But the one thing it doesn't do is it doesn't track sectors. So there are other trackers out there, which is in my plan this year. I'd like to look at other ways that people can track their portfolios and probably do some videos on those so we can explore what do they offer that other ones don't. Wealthica is more of a global snapshot. This is my Wealthica account. Now you do have to pay for it. They do have sector allocations, which is the two grayed out areas here. I don't pay for that right now. But once you add in, and it's the same concept as passive, so I link all of the different accounts to Wealthica. And then what it does is it takes all that, adds it all up, and it breaks it down. You can see the asset allocation stuff on the left-hand side of the screen. So obviously the biggest portion of my portfolio is strictly equities. I have a little bit of Bitcoin, and then it'll track how much cash you have. And it breaks it down by currencies. And then if these weren't grayed out, you would see the geographical part. But right now, because I'm a small channel and I don't want to invest money in tools that I don't necessarily need just yet. Although now that we're talking about it, it does open up the question, should I be paying for the next subscription? Because it would give me that, and I would be able to show that to you guys, what sectors we're also invested in. And then obviously the other nice part is that it breaks it down by fund. And then if you open up this, it would break it down by each account so you can see performance. And now these are not all of the performance metrics in here. It's just the ones that come with the version that I currently have. And folks, there's no affiliate link for this one, so you're getting my genuine comments on what I feel about it. I do like Wealthica because you can see here as I scroll through, I can see performance metrics for all of the different funds I hold. And as I mentioned in my last video, when I see one like this where it's red, that's where I kind of stop for a minute, have a look. Why is it red? Now, keep in mind that this is more than one account. This is all of my VNQ, which is REITs for in USD. So it's inside of it. There's several different accounts that hold it. You can see there's 2 accounts that I have it in.
How many positions do you have? You look like you have more than I do.
So I have a lot, but as I said, so I'll just highlight. That's a great question because we did mention this. So let's look at it just from a simplistic version. So here at the top we have VOO. It's my biggest position, and then if we scroll down to the one right here, we have VFV. They are the same fund. So VFV is in CAD and VOO is in USD. Exactly the same fund through the same fund provider, which is Vanguard. When you invest in VFV, you're investing in VOO. So
Right.
you invest in it on the Canadian market, they and then turn and invest in VOO. That's how it works. So if you're looking for US exposure, you need to convert your funds. And there's a number of different ways you can do that. I personally use Norbert Gambit. So that's where you buy one fund, and then that's converted over to USD, and you're saving on some currency conversion when you do that. And then obviously you can use, like if for instance I use Wealthsimple, your broker will have some way of allowing you to convert funds, but they're going to charge you higher fees. So obviously fees are important. With Wealthsimple, it's a 1.5% conversion fee unless you're in a different class within Wealthsimple. But that currency conversion fee can cost you a fair bit of money. So if we were to scroll down, you're going to see some repeated things, sort of the same thing. So I mentioned VNQ. I also hold VRE. VRE is a CAD listed REIT ETF, and VNQ is a US listed one. There's different ETF or different sort of companies inside of those funds, but they're effectively the same thing. They're just in different currencies is all. So we could probably cut these in half from what I actually have. And then the only other thing I'll point out, seeing as we're on the subject, is at the very bottom, I have some single holdings. So if for you, Paul, I imagine these would be like holding Tesla, or if you held I don't even know, what are the single fund cover calls?
Oh, there's so many. There's so many. Just
Yeah,
about
so
every, like there's Apple ones, there's Nvidia, there's Palantir, there's Google, um, just about Microsoft, Eli Lilly, just about any big, well, the Mag 7, right? They're all covered.
right.
Yeah.
Yeah, so if you look at what I have at the bottom, I have some single stock holdings. Now, when I started investing with zero knowledge or experience, I did what you're doing right now. I watched Paul and Darren, or I watched all these other creators, and I started to come up with a plan on how I wanted to start investing. And so I bought all these single stock positions that you can see. So Google, Amazon, ATD, BAM, so on and so forth. I actually had, I think, double that, and I've whittled them down. The one that I'm looking at perhaps liquidating right now, and this is actually a good time to sort of talk about this because you can look at it from your cover call perspective. So CN, that's one of my holdings. I have about, what does it look like? About 6,000 in it right now. It's not performing well, but the economy as a whole is not doing well. So that means companies are not shipping things as much as they would, and we only have 2 railways in Canada. These railways have moats. Nobody can come in and put a rail system in place and start shipping things around the country. And so lately, CN hasn't grown as much, where CP just bought, in the last year and a bit, they bought an American railroad to extend their service down to, I believe, into Mexico, if I'm not mistaken.
I think so.
Now, when I look at this particular fund, I hold it individually. So when I bought it, I started owning it when I first started investing. So did I have conviction in the company? Well, I just explained to you why I would. I have conviction in Canadian company that has a good moat. I get that as a total beginner. But should I be holding CP instead because it's, performing better? I don't know. But if we go back up, I already talked about XEI. So if we're looking at some dividends, XEI has that within it. And then the other one is XIC, which is down here. That's the TSX. So I actually hold, there's that duplication I was talking about. So the
Hmm.
question is now, if CN's not performing super well, do I just liquidate it? Do I sell it off and then keep those two other funds because I hold it within it? Do you think about your funds that way, Paul?
Yeah, well, that's exactly what I'm doing right now is taking a look at my funds and seeing where I've got too much duplication, too much overlap. And one of the ones I noticed the biggest was I think about six different Nasdaq funds. I had QQQY, I had QQQT, I had QDTE, I had QDAY, I had TDAC, right? They all hold the Nasdaq. So I'm kind of going through and trying to figure out which ones are underperforming, like you're doing, and getting rid of them and
And
just
you're willing
moving.
to sell, and you're willing to sell those at a loss to liquidate them?
Well, you know what? I went through and what I did was I added up all the dividends that they've paid me and take a look at the unrealized loss at the moment if I was to sell. And in most cases, I'm actually positive. But like QQQY, I've had it for a year, maybe a year and a half, something like that, and it made like $225. It's not right. It's a long time to hold something to not make very much money.
So that's actually, let's explore that a little bit, because that actually opens up an interesting question. Because I've gone through the same thing as I don't know, am I the growth investor? Is that what we've decided? I've gone through the same thing where I look at something, and if you watch some of my old videos, you'll hear me talk about it. Where I'm like, and I'm telling you right now, it's the end. It's not performing well, but I think I need to look a little bit more about performance long term, because a
Yeah.
fund, well, like a stock like that, or if we're talking about one of your covered calls, you can't zoom in, because if you do, you might think, well, I only made $200 in a year, but maybe over a longer period of time, it might perform better. So do you do you think about that when you're like, oh, I should liquidate it, but maybe if I hold on to it longer, it might perform better?
Well, what I'm doing is, let's say, for example, I have five funds that hold the Nasdaq, right? What I'm trying to do is figure out which one or which two of these five will perform the best. But it's like you said, past performance is not guarantee of future performance. You never know, right? But just trying to predict which one will outperform, and then that way, I mean, I could be wrong. Like maybe I sold QQQY and 2026 is going to be its best year ever. It's possible, right? So you're kind of taking, and what I did was I actually posted on Blossom and I asked people, okay, out of these four funds, which one would you sell? Right? And QQQY was the one that most people voted to sell. And then another person actually asked, I think AI, you know what I mean? Which of the funds I should sell? And it broke it down, which ones to get rid of and why, and which ones to keep, which was kind of cool. Um,
A word of caution with AI. So I have been using AI. It is, I think, the rage. If you're using Chat GPT, it is a fantastic tool, but don't take it at face value. So I like that. I do the same thing. I'll ask it, hey, here's what I'm thinking. And in fact, I've actually proposed that question about my wife's RRSP.
mhm.
Here's the situation. And I even cut and paste all the information directly from Wealthica and then inputted it and said, here, what do you think we should do? Now, it obviously didn't give me a hard and fast answer, but when you ask it to research those topics for you, specifically about funds, it'll show you on the bottom line, it'll show you where it got those references. And some of them are coming from Reddit. So I don't know about you, Paul, but I,
Yeah.
if
There,
I'm reading something that someone wrote in Reddit, I
yeah.
want to make sure that it's credible information.
I did ask Chat GPT as well the same question, and it listed a whole bunch of points. And one of the points it listed, it did say popular opinion. So
Right.
like within the investing community. But if you know something about the funds you own, like which ones use covered calls, which ones use swaps, which ones are zero DTE, and then you read what the AI is telling you, you kind of recognize and you realize it knows for the most part what it's talking about.
Yeah.
It's actually, we should.
When you're looking at picking single stocks, whether you're a growth investor or an income investor, you have to have some conviction about the company that you're looking into. And that's why, even for dividend investors, you have to take the time to learn about the company and what their future goals are. So you'll often hear them say, like, for instance, I'm going to listen to the CN quarterly call or the year-end call, because in those meetings, they're telling you how much money they're earning, what's influencing their bottom dollar, and what their plans are for the future, which creates the conviction that you need to
Yeah.
invest in that company. Now, we know that there's only 2 railways in Canada, and that moat will not change. It's kind of like the telecoms companies, same idea. So picking one and having conviction about it. I also seen people say they'll do 50-50. I'm going to
Yeah.
put 50% of whatever I decide. So if it's 2% of my portfolio, 1% will be in CN and 1% will be in CP, equal weighting them,
Yeah.
which then always brings you back to, well, why don't you just hold an ETF? Because then you don't have to do all the research.
That's
You can
right.
just hold the market. Are you going to get that big return? No, you're not. You could take the time and it's like gambling, right? You learn more about the company, you have conviction, and maybe you do make better returns in the long run. If you think about the top 7, that's why the AI bubble is such a rage of conversation. AI's hit the market. It's out there. We're talking about it right now. But those top 7 companies aren't necessarily the next one that will do well. The one that's going to do well might be number 10 or 20.
Yeah.
And trying to figure that out is tough. So, for instance, there's a lot of talk about Apple right now because, well, let's face it, I'm an Apple user. I have Apple products, but the difference between the iPhone 16 and the 17 is not revolutionary. It's nothing exciting.
No.
AI seems to be the next rage. How do they introduce AI to keep their company growing? For instance, when you search on Google now, because Google is obviously the biggest search engine in the world, which, by the way, it's also YouTube. It's the same thing. So when you search in
Right.
that search bar, you're now getting AI results back. AI
Yeah.
is the rage. So all these companies are now having to introduce AI to continue to see their companies grow. So the question is, will there be 8, 9, or 10? Will that be the next company?
My question is, with you being such a busy guy, right, working full time, you've got young kids and a wife, and you've got your YouTube channel. Do you really have time to keep up with individual stocks? Actually following them, doing the quarterly. I know. When I own things like TD Bank, I never listened to their quarterly earning reports, or I never did the due diligence that you probably really should be doing. So that's one of the reasons why I've kind of gotten out of single stocks for the most part.
Yeah, so that's actually great. So for me, that's one of the things as I put in my goals for this year. Last year, I had said that I wanted to learn how to evaluate a stock. That was something I wanted to learn how to do. Unfortunately, it didn't come to fruition, but that is definitely on my plate for this year. We're talking about it in this video. That CN position is one that I'm really agonizing over right now. It's
Yeah.
not a huge part of the portfolio. If I was to sell it, I'm not losing a great deal. There
No.
were some distributions that were reinvested over time, but it I think sometimes you have to consider I do that even with my cover call positions I've held. I will do what you do. I'll look and say, okay, well, when I look at the fund right now, the share price has fallen, but then I'll put the distributions back in to say, okay, well, if you look at that, I'm breaking even. If you want to look at it through that lens, it might not even be the right way. I know some people don't agree with that, but at the end of the day, a lot of investing is psychological. So for me, it makes me feel better to be like, yes, those distributions make me break even. So no, that is definitely something I'm going to look at. Now, the positions that I do hold that are single stock positions, with the exception of CN, are actually performing very well. In fact, they're performing better than some of the ETFs that I hold. But the question is, when will that stop?
That's right. Well, you've got some good. I mean, I think I saw you have Google and you have Tesla, right? So you've got some really good quality stocks, and when they're performing well, right? They outperform. Something like XEQT is not going to outperform an Nvidia or a Tesla, when they're doing well. But you look at the risk, right? It's the risk reward. I think that you and Carl always talk about with XEQT. It really reduces your risk. There's always risk, but reduces your risk, but you still get a good return out of it.
I actually had a comment on one of one of the videos I did recently where I talked about I was looking at Wealthica and I was talking about the returns at 9%, and I got a comment back that said, well, that's not revolutionary. It's like, I think the math said it was like 0.67% per month or something like that. And I responded to that person saying, you have to realize that before 2023, my money was doing nothing.
Yeah.
That's a big fat zero. So for me, when I look at that, I think, like you said, when I balance the risk, can I go to sleep at night and not worry about tomorrow when I wake up, when the market opens up, that the screen just goes completely red and I've lost 30% of my portfolio? I can go to bed easy. Yes, I'm not killing the market with XEQT, but my money's growing. And we talked about it earlier. Look at the returns over time, 106%. That's not too shabby for, like
No,
you
it's not
say,
too
a
bad at all.
lower risk fund. So, and like you said, when you manage your portfolio, figure out what to concentrate in, and then some people have play money, right?
Yeah.
Do you think about that? Like, do you have play
Oh,
money?
100%. Like when people ask me, why did you invest in Alti or something like that? And the way I always look at it is I'm not the kind of person who would take $500, go to the casino and have a fun night. And if I lose the $500, who cares? For me, I'd rather put the $500 into Alti and at least it pays me on a weekly basis. And if it goes up in value, it goes up. If I lose it, I lose it. But that's my play money. That's my gambling, investing money.
I don't think there's a single channel I've watched or listened to, Spotify, like to podcasts. I find that most investors, after they've sort of discussed the main part of their portfolio, a lot of them they're like, oh, I have like 0.5% or whatever amount of money, and this is my play money. You'll hear it all the time.
Yeah.
And even Carr said he responded to a comment on Blossom there, where he mentioned how, because I said, like I'm investing in cover calls so I can learn about them, right?
Yeah.
Skin in the game was that post. And I thought it was interesting. And he basically said he kind of understands why someone would want to do that. If you've never gone gambling to a casino, well, if you're going to try it, you got to go try it.
Sure.
So I thought it was kind of interesting. Now, does that mean I'm going to put all my money in all these things? No, of course not. We've already demonstrated at the beginning of or somewhere along this video, wherever it comes up, that I can measure the performance of these things against other parts of my portfolio and weight it appropriately so that because we know that these cover calls, though, don't have that downside protection. That's really the big thing. So if tomorrow you wake up and the market took a dumper, those funds are going to drop in share price a lot more quickly.
Do you ever think for how much Carr knows about investing? Like, because when I hear him talk, it's like, well, I guess it's kind of like a Ben Felix Jr. You know what I mean? It's just the level that he understands investing is amazing. But at the same time, he just has XEQT, which is fantastic. But in my mind, it's almost kind of like the lazy man investment. You know what I mean? Just buy XEQT, instead of picking one or two stocks, you pick 8,000. And so what I'm trying to say is actually a compliment to him. I think he's one of few people who probably could pick really good stocks and make a lot of money, right? Because he seems to understand the market so well. He understands investing. He understands risk. He understands all the fancy, sequence of returns, terms, and all that stuff that I think a lot of us don't actually understand as well as he does. But
again,
at the same time, he must get bored of just holding XEQT.
Well, and hopefully we'll direct him to this video, or I know he does watch this content and he does make comments, especially when I post it on Blossom. I 100% agree with everything you've said. But the one thing that I do know is if you guys listen to the Rational Reminder podcast, you will have a better understanding of why Carr says the things he does. We know that there is research that tells us that over time, and that's the key here. And I think that's why our conversation is kind of interesting is, I said that I wanted to see our portfolios compared against each other, but it's impossible because I'm putting money in. That was an unfair comparison. But you are in a situation where you couldn't put money in. You were laid off and you had to figure out a way to generate some income. And if there was one situation where I think that this might work, it's obviously this. Now, the test over time is to see what happens. Now, for growth investors, the time horizon is so much longer. So over time, and that's what Carr is alluding to, and Ben, is that statistically, it's proven over time that if you are doing exactly what you said you think he should do, you'll end up losing money. So I was actually talking to a guy at work who does that. He picks stocks, and he said he's lost far more money than he's ever earned.
Really?
So, well, that statistically, you think about it, you can't predict the Nortel, let's use Nortel because Ben just talked about it in his last video. Nortel was the company at the time, like
Yeah.
technology wise, it laid the foundation. And what happened to it? It went out of business. People that work for that company, they had shares. Their pension plan was the shares in the company, and
Yeah.
it went belly up, gone, like disappeared. So even though a solid foundation company that may have been researched existed, even it went belly up. And that can happen. It's true.
You,
But when you look at he used the vanilla approach, and it's boring.
yeah.
But look with inside of XEQT, and you'll see why. You're owning everything that we talked about it. The market is balanced, the sectors are balanced, and they rebalance that for you. So from that perspective, I can see why I think that fund is medium risk. Like and other thing about that fund is it's all equity. So
Right.
when the market takes a downswing, when we talk about covered calls taking a larger hit in their share price because they don't have downside protection, that is true with XEQT and other all-in-one funds because it's all equity.
Yep.
Those companies, when they go down in price, you'll see the same change in that fund. But when you look at its performance over time, because it balances out, it's still performing well. The only year that it didn't perform well so far was 2022. But obviously a lot of things didn't do well in 2022. But it's actually an interesting question, and I think that's this part. It's the psychological game.
Yeah. I'd like to reach out to Carr and talk to him because now that it's January, I'm kind of planning my year and I'm trying to figure out how much can I actually extract from my portfolio, right, without hurting it. You know what I mean? And I know people talk about the 4% rule, which he understands better than I do. So I'd love to chat with him and say, look, I started the year with a portfolio of like $385,000. How much can I pull out of it according to his calculations without overdrawing my portfolio, and see what he says. I'd love to know what the actual answer is. You know what I mean?
Yeah.
Based on the real math that he understands, which I really don't. For me, it's a journey, right? Like I'm just kind of learning as I go and seeing where I end up in the long run. But
Paul's talking about is called the 4% rule. Some of you may or may not know what that means. It comes from the Trinity study, and Carr schooled me on that one because last time you and I had mentioned it, we talked briefly about it. And what I had said in the previous video is that the 4% rule is a bit outdated from when it was originally a concept, but the premise for it, it still exists. Because as you just demonstrated, you need to know how much can I reasonably withdraw from this account every single year based on those returns. That's the key. So one of the things I think is important, and I know Carl will probably watch this and maybe steer me right if I get this wrong, but when you get close to retirement, you need to have some fixed income. For that very reason, I just pointed out, even XEQT will react to market downturns. So imagine the share price has gone up, I don't know, we'll call it 25%. And in one day, you see a major downturn, the share price drops, and it's now that time that you need to withdraw your, we'll call it $25,000. I'm just using a random number. That's what you're
yeah,
taking out this year. You're now going to realize that loss when you withdraw that money because that reaction happened in that part of the time you wanted to take that money out. So having some fixed income or some other way to protect that money when you need it is important. And then obviously the 4% rule is if they basically say that if you reasonably take out 4% of that portfolio every year, you should have enough to survive on. But you need to figure that out first. You have to
yeah.
figure out, what do I need? And so that if you go back and look at and there's other calculators online. I just happen to use one that I've been using for a while now. It tells me based on the portfolio size, how much money I'm going to put into it, and what I want to live off of based on my age, how much I will need in retirement down the road.
From what I don't know if it was watching Carr. I think it was watching him speak about it with you probably. From what I understand, the whole premise is that you could retire, and the first couple of years you retired could be really bad markets. You know, maybe the market crashes, so your $1 million portfolio goes down to like 700,000, and like you said, all of a sudden you're pulling money out at the worst possible time. So the
Yeah.
4% rule somehow protects you from that over the course of your retirement. I mean, things could go the other way, right? You could retire and the next 5 years could be the best years ever, and then you wouldn't have to worry about it. But I guess they're trying to factor in, the worst possible years. Darren, we're already over an hour here. I'm wondering, are you going to give us any hints as to how your portfolio did last year, or are you going to wait till
Yeah, so
your
I will do
year-end
my year-end
video?
video. I will say that I'm happy with how well, first of all, I'm happy with the channel's performance because the channel kind of dictates everything I do is put on the channel. That's the transparency part. I'm happy the two of them I've got them going. I have a system. That was something else that I want to put in place for editing, for planning. That's another one. So Paul and I said we would do this once a month. That makes my planning a bit easier. As far as the portfolio goes, I'm in the midst of, like I said, rebalancing, which will set the tone for where things are going to go. I'll drop a little bit of a hint. So some people have been saying, and I think you even might have hinted at it. Actually, you did actually hint at it in one of our videos. If I hold certain funds and yet XEQT performs the same, why not just lean into XEQT?
Mm.
So stand by. We'll see what happens there.
Yeah.
But the cover call experiment was, I guess we call it experiment, was interesting. It definitely opened my eyes. I learned a lot about cover calls. I think I want to learn more in general. You tend to know more about, the 0 day, what is it? Oh, 0 day to return? Is that the terminology?
It's zero DTE, so 0 days to expire.
Right. Sorry. That's
Yeah.
right. So 0 days to expire. And I actually was able to explain to somebody the other day. We were talking at work about stocks in general, and this person mentioned some things about this stock, and I said, man, that is what a covered call is. Like, that's how covered calls work. And
Yeah.
then we talked about that. And so as far as those things go too, having an understanding of how they work has grown my mind. In your sequence of returns, or your returns, I guess, in general, it makes sense. In my case, I'm still I don't think they work for somebody who's accumulating.
Right.
And you've already pointed out today that that if you do hold them, that having them as sort of the engine to produce more for the other parts of the portfolio might be an interesting way to use them. That's a puzzle I'd like to dive deeper into. Does that actually really make sense long term? Now, as far as the other funds in the portfolio, they're boring. I set them up the way that I did. I rebalanced them last year. I keep putting money into those. I actually stopped doing the videos where I showed exactly what I bought because I was just buying the same things. The covered call experiment gave me obviously something to learn about, different funds to look at. So I still feel like I want to learn and talk more about cover calls. As far as my growth side of things, it's going well. Like I am blown away about what I was able to accomplish. And something else that I think is important for people to remember, and that's why your conversation with me is unique. You're showing people what you can do with your money when you're not adding money. And
That's
I'm
right.
showing people what happens when you start late. The other thing is we have a goal, right? I use that calculator. I figured out how much money do we need on top of my pension so that we can retire, and that is the bare minimum of comfortableness, right? And legacy. That was something else I talked about. I realize now that it's not just for us; it's for our kids as well. That goal, it's $577,000, and as you can see by the last video update that I did, I was at 448. Markets were not that great over the last 6 to 7 weeks. But I know
Yeah.
that will change and will continue to grow. So we're closing in on that, which means that there'll be a surplus. So that makes me really happy, makes me sleep at night. You?
Yeah. Right on. I mean, my portfolio didn't do as well as okay, I wouldn't say it didn't do as well as I hoped. You always hope for more than you end up with, right? I didn't beat the markets, if that means anything to anybody. I know Mark, Brandon's dad, did a video a few months ago talking about he doesn't think everybody should measure themselves just against the market, because you should measure yourself against your own personal goals. So my goal for the year was to extract money out of my portfolio, but still have my portfolio grow, and it did that. Um, had Bitcoin gone the other way, had it gone from 126 to 150,000 and MSTR had it gone up and Coinbase had it gone up, I mean, I could have probably easily beaten the market. So I'm not too upset about it. I think those things will switch. Maybe 2026, maybe 2027. Who knows? Apparently, the 4-year cycle is no longer a 4-year cycle for Bitcoin. I watched a video. This guy broke it down really well. Apparently, now they think it's like a 5.5-year cycle. So who knows?
Yeah.
Yeah, who
And
knows? But
Bitcoin's a different beast too because it doesn't have an intrinsic value. Like, well, maybe that's not the right way to put it, but like, I heard a dividend investor say, like, I don't like current cryptocurrencies because they don't provide you with income,
right,
whether it's a dividend or anything. And maybe I didn't say that right. It has an intrinsic value, I guess. You and I make that value. So
yeah,
if I have my crypto coin and I'm like, oh, I want to sell this, you might say, well, I'm going to buy it for X amount of money. It's kind of how the markets work too, as far as efficiency goes. But it doesn't go beyond that. Like
yeah.
there's nothing that happens to it. Like, for instance, if Amazon says we're creating the next best iPhone with AI, wow.
For me, it's the same thing as like gold, right? A lot of people put a lot of value in gold, but if you watch Warren Buffett talk about gold, and he's considered to be one of the best, if not the best investor of all time, he basically thinks gold is useless.
So you mentioned that your portfolio didn't perform perhaps the way you had hoped it would, but at the end of the day, you said that, I'm going to withdraw money. This account will grow over time. Do you still feel accomplishment from that part of it?
Yes. Oh, definitely. Yeah, yeah, yeah. And
It's better than a savings account.
oh yeah, way better. Way better for sure. Definitely
Yeah.
better than a savings account. And I think this is going to be a good year. I think 2026 is going to be a good year. I'm starting off the year, my portfolio is producing less money per month than on average, say it would have last year, I think, at the end of the year, not the beginning of the year. But I'm trying to get away from the high yielders. I don't know if you ever watch any of Perry's videos, but he calls them the juicers, right?
Yeah.
And they do produce a lot of income. So you could say, hey, I'm making $5, 10, $15,000 a month. But then when you go back and look at, okay, but I bought $20,000 worth and now it's only worth 15,000, or now it's worth 10,000. You know what I mean?
I
So if
do.
it's got to be, I want funds that are more stable, where the NAV and the share price, maybe it goes up and down a little bit, but not a lot, but it's still paying you those monthly distributions. They might only be a 10% yield or a 12% yield as opposed to a 60% yield, but at least you're not losing money on the back end, right? They're not just
Yeah.
paying you these ridiculous payouts, but on the other hand, you're losing money faster than you're making it. So,
Actually,
because
that opens up print question. So HDiv, you don't hold HDiv, right?
what I started buying, so I held HDiv a long time ago, and when it went up, I was up. I think I started buying it around $12 a share, and maybe it was around $15, $16. I decided to sell it and move the money into something that had a slightly higher yield at the time. I can't remember what it was, but HDiv has done so incredibly well that I'm buying it now in my margin account.
Okay. HDiv though, do you know what the MER on that is?
No, what is it? 1.5%, 2%?
Yeah.
Yeah.
2.4, I think. So that came up in conversation. I can't remember if it was Blossom or someone left me a comment. And anyway, I dug into it, and sure enough, yeah,
It's
really
high.
high. But then that opens up, of course, another piece of conversation. What about the cost to hold these with these higher MERs? And that one's huge. Yes, it might be performing well, but like, if you were to compare that against some other funds, aren't you paying significantly more to hold it? And yet it's not outperforming by double. Like, the MER is double what Alti is 1.4.
Oh, wow. I can't remember which Canadian ETF Adriano uses to compare HDiv against, like, because the underlying holdings are similar, but apparently HDiv is actually outperforming it,
So it does. I
right?
did. So I have on the Google search engine here the two different website links. I'll put them in the video description. It's called Drip Returns or the Dividend Channel, and you can compare different funds with the returns included. Once you get on the
Purely
main page,
Canadian.
what you do is you go over to calculator
Yep.
and then you type in the symbol. So in our case, we're going to do HDIV,
Looks like it's just Canadian.
and then we'll compare it against VFV. Here we have, this is a straight comparison. So one is with distributions reinvested and one is with not. So, and you can see at the top, that's with reinvested. So we have HDIV on one side and VFV. I just picked them as a random comparison. And then the bottom is with not reinvested. So
How
obviously
come
the
it's
blue,
VFV.ca? Well, VFV is Canadian, isn't it?
yeah, that's what I was
It's
saying before.
Canadian.
So
Yeah,
VFV is listed on the Canadian index
yeah.
and reinvests in VU. If you had invested $10,000 in HDIV, and $10,000 in VFV, you would wind up with dividends reinvested, $20,246 with HDIV. So obviously it outpaced VFV, and you would end up with $18,449 when it as far as those returns go. If you look at without dividends reinvested, they're basically the same with HDIV trailing behind. So the question I had posed to you, which I'm interested in, is now knowing that the MER is so high, that's a lot of money.
It is, but I mean, now that you're looking at this, doesn't it make you wonder, like, maybe HDIV is not such a bad investment as long as you're reinvesting the dividends?
No, I agree that with the dividends reinvested, it's definitely outperforming and outpacing. But what will
Which is
happen
hard to
more
believe,
long?
eh?
It is, but what will happen more long term? That's kind of what my lens always is thinking this is
Yeah.
short-term window. What will happen more long term? That's the real
Not
question.
not
And
only
is
that,
it
but you're comparing the Canadian market to the US market, and the US market typically outperforms the Canadian market, right? So
true?
chances are if you do this for, say, another 5 years, VFV will eventually outpace HDIV, but the US market's going to outpace the Canadian market anyways.
Sure enough.
So
And so
this is a tough comparison.
my big question though is if I'm paying 2.4% as an MER, shouldn't I expect better performance than that? Because that's not a huge difference.
Yeah, I don't know what to tell you, Darren. I guess like you said, it's just for people who the peace of mind maybe of not having to sell your VFV shares. And I guess like the one on the bottom, it says without dividends reinvested. So the one on the bottom, you would assume the person is using the income from HDIV, right?
Yeah.
But in order to make it apples to apples, the person with VFV would have to sell shares in order to produce their own dividend, right?
Yep.
So would their balance still be as high as it was if they were pulling money out of VFE,
Right. Which brings me back,
right?
which is full circle now, is so from my lens at the time of me, adding money and growing the account, that's why I'm not convinced that holding these now in the accumulation phase makes sense. In this
Right.
scenario, so let's say I'm I'll just say 2 years away from retirement. I could start and we're going to assume the market is going well. Obviously, if it's not going well, we're not going to do this, but let's assume the market's performing strongly. I could then withdraw money or sell shares from these other funds and put them into a fund like this in the short term and start generating that income. Does that make
Yeah.
sense?
Yeah, it does
So
make sense. Yeah.
instead of doing it now, because the growth that I'm going to get outside of a fund like this one, I think that high MER is really what impacts you the most over time. That's kind of what I'm saying. So I think it's better to let those growth funds work, till you get to that point when you're thinking, okay, now I want to generate some income.
Right. No, you're 100% right.
So just some sum up thoughts about 2026. You said it's going to be a good year.
Yeah, well, for me, Darren, I think I'm going to be more focused on quality, right? As opposed to I saw a statistic that I think last year, maybe in North America, they launched something like 1,200 new ETFs, right? So we're always being flooded now by new companies and existing companies with all these new high yield, covered call ETFs, et cetera, right? So you kind of get caught into the trap of always trying to find the next best thing. And then a lot of them don't perform well or don't do well or underperform. So instead of chasing, so many different income funds, I'm just going to try to focus on the better quality ones, and that's why I'm bringing my portfolio from over 40 holdings. I think I'm going to try and get it down to 20 or 25. We'll see. I'm not 100% sure. Like yourself, I have some US and some Canadian. So you end up, if I only had Canadian, there'd probably be half as many. But yeah, I'm going to try and bring it down that way and focus on quality over, I guess, quantity. And just try to make better decisions in 2026. But I think I'm going in it with a positive mindset. And already my monthly income is a few $1,000s higher than it was when I started the beginning of 2025. So I think I have a good base to build off of. Now it's just a question of not wasting time putting my money into funds like Alti, right? That are just just going to tank in although I still own Alti. That's still an ongoing experiment because I own it. So I'm just going to hold on to it for now and see what happens. See if yield max. We're giving them a fourth chance to try to improve this fund. Is it? I don't know. Are we up to? I don't even know. Is it number 3 or number 4? Who knows? We'll see what happens. It might not make it to next year. Let's put it that way.
Yeah, I think for me, for 2026, again, I've already talked about it. There will be some streamlining, some changes to the portfolio. I am, as you, I'm happy with where I got to. I want to hit those goals. So a few goals are maxing my TFSA out. That was my original goal. I'm 3/4 of the way there.
Nice.
And it highlights the importance of having a plan and sticking to that plan, and also planning ahead. That's a big focus I'd see now, using that calculator to plan ahead to know what that goal should look like, because things can change. So that goal is set right now, and I want to achieve that, and then we'll move past that. So TFSA maxed out. Streamlining a little bit. There's a few things I think we'll end up cutting out. I've already hinted at some of the cover calls. I'm not sure that they need to stay in there. And obviously from the YouTube side, I have a bit of a plan about how I want to get through the rest of this upcoming year. I really want to grow the channel. I'm excited to say I hit 6,000 subs.
Nice.
That is absolutely mind-boggling for a regular Canadian dude who didn't really know too much about this. I am also always very excited to see when people say that what we do helps them. As you say, they're motivated more than anything. And
Yeah.
this keeps me motivated as well. So yeah, I want to see that portfolio. I want to see that snowball, that's kind of the effect that you hear about after that first 100,000. And I'm seeing that now. Yeah, so that's kind of the exciting part for me, I think, moving into 2026. And yeah, if you guys like this content, like we've said before, the like and subscribe, sharing is a key one. But I do have a playlist for the videos that we've done. And if you guys want to check those out, see what other stuff we talked about, you should watch this video playlist right here.